Good day, everyone, and welcome to today's SOFTRAX Executive Webcast. During today's presentation, all lines will be in a listen-only mode. Also, as a reminder, today's call is being recorded. At this time, I would like to turn the call over to your host, Mr. Bob O'Connor, President and CEO of SOFTRAX. Please go ahead, sir.
Well, thank you very much, and welcome, everyone. SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today, so welcome. We have approximately 1,000 registrants for this webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker. Dr. Tony Sondhi is backed by popular demand to make his presentation entitled Update on Current Revenue Recognition Issues, Post-Contract Support. In this situation, Tony is doing a deeper dive on one particular topic, and by the fact that we have so many people joining us, it's such an issue for so many companies. And Tony will be available for comments at the conclusion of his prepared remarks. Our audience consists of CEOs, CFOs, venture capitalists, VPs, accountants, and other corporate and financial professionals. Let me take you through our agenda, which is on your screen. I'll just spend a few minutes talking about SOFTRAX and revenue management, and then we'll turn it over to Tony to talk about revenue recognition issues around PCS. For those of you who are unfamiliar with our webcast format, we will leave about 10 minutes for you to ask questions, and all of this will be concluded by the top of the hour. And we have a lot here, so we'll move right along. To ask questions, what you need to do is look at the Ask a Question feature located on your console and type in a question at any time. I'll be reading the questions during Tony's presentations, organizing them to ask Tony when he is done. And the most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for them. But there are lots of slides, and I'm sure you're going to want them. So after the webcast is over, your browser will be automatically redirected to a short online survey. We listen to these. We look at them carefully. Today's webcast is a result of previous feedback questionnaires where people said, I want to do a deeper dive on PCS. To fill that out, and if you do fill that out, you will get copies of the slides, for one. You will get CPE credit for those who would like them. So we need the questionnaire in order to fulfill the CPE credit. And you'll also be eligible to get 10 of you to get a copy of the revenue recognition guide, which is extremely valuable. And our guest speaker is the author of that document. So that's our housekeeping issues. Let me just spend a few minutes, as I promised, on SOFTRAX and revenue management. SOFTRAX delivers enterprise software that manages all aspects of a company's revenue. And throughout the U.S. and world, hundreds of companies from many different industries use our software products to manage their revenue, their billing, revenue recognition, reporting, and forecasting. And as you may know, SOFTRAX started by serving the complex revenue needs of software companies, and we're the clear leader in that market. And as you can see, we have grown to address complex revenue needs of many other industries. In a recent study by IDC and RevenueRecognition.com, a website that I encourage you to visit, it was found that most companies still use spreadsheets to manage critical revenue processes and activities, and this is a source of much material weakness. And the regulation pressure continues to rise. As a result of Sarbanes-Oxley, more than half of the public companies and almost half of the private companies have changed their revenue recognition policies. And CFOs and other executives do not lack for challenges in today's environment. They have operational challenges related to their business models, and many have more complicated business models. It's certainly a trend that we've seen over the past few years in terms of how to manage whether they're subscriptions or maintenance or on-demand or transaction-based models, managing their contracts with their customers, managing their revenue and compliance, being able to comply with issues like Tony's going to talk about today in terms of revenue recognition guidelines or Sarbanes-Oxley. And they have issues with respect to visibility and financial reporting and challenges around making sure that financial reports are accurate and timely. And our solutions are closely aligned with these challenges. Our solutions include billing and operational applications that allow our customers to increase their efficiency as well as increase revenue. Compliance applications that really enable complex revenue and expense accounting to support compliance initiatives, and business performance and the strategic applications that allow companies to really take a very in-depth look of their revenue as well as forecasting revenue. detail level, our applications are organized similarly, where we have applications that manage contract management and renewals and complex billing, deep and really unparalleled revenue recognition capability. You'll see on the screen VSOE issues and other revenue recognition issues that we'll talk about today. And on the right, strategic applications that provide insight into helping our customers and their executives make better business decisions. And they can be complemented by other applications. And all this functionality can be licensed individually or in terms of an entire suite. And this unique functionality is provided in really two major offerings. We have complete billing and revenue management applications that really help certain industries, and you can see the industries listed there, industries that we focus on, whether software companies or SaaS or e-commerce or internet or information providers, full billing and revenue management applications. And a relatively new offering for us, a revenue recognition, allocation, scheduling, forecasting for those companies that have invested in ERP systems. And this functionality can be used to manage revenue that's already been booked, or that revenue that's contemplated and being used in forecasted business for those companies who would like to look at the revenue implications of what business might look like after it's booked, but look at it before it's booked. And this application is very highly configurable for many different industries. We're pleased that our customers across the board report strong value, much improved compliance, whether it's with Sarbanes-Oxley or revenue recognition guidelines, much higher efficiency, whether it's just across the board in terms of all aspects of billing and revenue management, and increased customer relationships and improvement in customer relationships. So our mission is to help our customers increase their revenue, reduce their operational costs, and all the while complying in this environment that we now live in. So as I mentioned before, backed by popular demand is Dr. Tony Sondhi. He is currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Board, FASB. And he's also the co-author of the 2006 Revenue Recognition Guide, and the author of the Analysis and Use of Financial Statements, 3rd edition, and many other books and white papers, and he has served on many committees with respect to issues that we're talking about today. He's also an advisor to several U.S. companies and foreign companies, talking about consolidation issues, as you'd expect, revenue recognition issues, revenue arrangements, financial reporting, and things like that. So, Tony, if you could fire up your slides, and we'll give you the floor, and I'll be back to ask you some questions, and people feel free to ask questions during Tony's comments, and I will read them throughout. Tony?
Thank you, Bob. Good afternoon, everyone, and welcome back to those of you who are returning. Appreciate your being here. So as Bob has pointed out, the topic that we're going to discuss today is a complex one. And also, as he's pointed out, there's a lot of slides in here, so we'll see what we can do with the materials that we have. And at the same time, let me mention that because of the complexity of the topic, one possibility is that we'll conduct a follow-on webcast so that we can properly address the issues with respect to post-contract support. Having said that, let's begin our work, given the amount that we have. I wanted to start it off by providing a fairly generally accepted definition of post-contract support. And we normally think about post-contract support as having three pieces to it, or three components, if you wish. And obviously, they're fairly commonly known what these pieces are, but they have some characteristics that we need to keep in mind. The first piece, of course, is phone support, and that includes all types of phone support. Most people in the industry think of them as three different levels. They may call them by different names, such as gold, platinum, etc., but phone support is the generic term that we're going to use as one component of post-contract support. The second, of course, is the bug fixes, corrections of errors, and similar services that are provided. And then the third component, which which is a little bit more difficult to deal with. That is the unspecified product upgrades and enhancements. So the three components are the two types of services, the telephone support, the bug fixes, and then the third component is the when and if available upgrades and enhancements. Now, there are some things, as I pointed out, you have to be very careful about. So let's take a look at this definition and see if we can understand it better. The first point I want to make is with respect to services. We're not talking about the services that are otherwise discussed in 97-2, for example, installation or training. Now, in 97-2, the other services are more fully described in paragraphs 65 and 66, but the characteristic of these, the attribute of these services that I want you to focus on with respect to post-contract support is the fact that one, generally speaking, has vendor-specific objective evidence of the fair value of those services. In other words, the paragraph 65 and 66 services. Why does that make a difference? The point is that when you have VSOE, fundamentally, it means that you can apply 97-2, you can separate those services from, say, the license itself. And because you have VSOE, either through the application of 97-2 or through the application of 98-9, you will be able to then allocate a portion of the total arrangement consideration or the fee that you charge the customer to the license and to those services. In other words, the presumption is that services that are included in PCS, one does not normally have the VSOE for. It is that reason which effectively results in bundling telephone support, bug fixes, and the unspecified, in other words, the when and if available product upgrades and enhancements, bundling the three of them into one sort of grab bag of a deliverable that we call post-contract support. Now, a couple of other points that I'd like to make with respect to this. What are the deliverables that are not considered PCS? And this I've already told you about services, so now what I want to do is to focus on the upgrades and enhancements. Clearly, if you've specified an upgrade, and normally what that means is that your customers are entitled to receive one or more of those specified upgrades or enhancements, and generally speaking, you would also see those being sold separately. The second category is where within an arrangement, a customer has a right to additional software products. These are two categories of upgrades, enhancements of products that are not considered components of post-contract support. Now, please keep in mind that with respect to rights to additional software products, that's one of those exceptions in 97-2, and the point being that if you do not have VSOE of the additional software products, which most commonly would occur if you were promising future products, that is, if you don't have them at the moment, the vendor is not completed or has not yet rolled out the product. But if the arrangement entitles the customer to those, then you're going to end up in, as I said, one of the exceptions in 97-2, which would be the subscription accounting. But generally speaking, if you were talking about additional software products that were available, and you would therefore expect to have the VSOE, in that case, it's not, that particular deliverable is not a component of PCS. Now, generally speaking, these components of the services and the unspecified upgrades and enhancements, which I pointed out are considered PCS, basically, if the only thing you're offering your customers is bug fixes, then what you have is the substantive equivalent of a warranty. Now, please keep in mind that warranties are accounted for under FAS 5, that is, you accrue the cost of providing those bug fixes. Now, once again, before I leave this aspect of PCS and of my discussion, let me point out that you really must keep in mind the fact that the implicit presumption that you don't have the VSOE of PCS. Because whenever you have an acquisition, remember, as a result of GAAP, what you have to do is to allocate the total purchase price to all of the assets you've acquired, all of the liabilities that you've assumed. And you must measure the assets acquired and the liabilities assumed at fair value. So it's an interesting problem, you see, that here we are talking about the components of PCS, which in a software company normally would be the primary source of deferred revenue or one of the larger credit balances that you see on the balance sheet. And on an acquisition, when you look at the acquired or the target entity, what you have to do is determine whether that deferred revenue, that credit balance, constitutes first a liability. And then the second question is, how do you measure it? And as you know, there's one EITF consensus that deals with this issue, and then there's another EITF. The first one was 013, and then we have 0411, where at the EITF we looked at this issue of measurement of PCS. But as I said, that's a sort of an extension of this whole discussion, and that may be one of the issues that we come back to when we do a follow-up. Okay? Now, let's look at the basic financial reporting requirements. And if we keep it very simple, I can actually give you a general principle, and that is PCS must be recognized on a ratable basis. That is, over the term of the PCS, you recognize it ratably. Now, the rationale for this at the outset, although they did consider when they were working on SOP 97-2, they did consider different ways of approaching this and recognizing it. But the sticking point, in a sense, is that it's very difficult to answer the timing issues. That is, when will the expenditures be incurred as the vendor provides post-contract support? Since the timing of those expenditures is a difficult one to determine or establish, it becomes difficult to determine any other systematic way of recognizing revenue other than a ratable basis. Okay? Now, of course, by the same token, what that means is in the event you have VSOE, then of course, and the VSOE and the evidence that you have suggests, or shows rather, I should say, that it's the expenditures are incurred on something other than a straight line basis, then of course you'd recognize revenue in proportion to that. In other words, you'd acknowledge and effectively translate that basis into your reporting methodology. Okay? Now, it is possible, but please be careful with this. As I've noted here, it's rare to make the assumption and then to sustain or defend the assertion that PCS is insignificant and that delivery is not required to recognize the revenue allocated to it. Now remember, we normally think about insufficient as having the following really critical characteristic, and that is, in order to be considered insufficient or perfunctory a deliverable, when you don't provide, when you don't complete this performance with respect to deliverable, it is not, I repeat, not going to trigger a refund. So if a non-performance of an obligation does not trigger a refund, you may assume that it's effectively insignificant or perfunctory. But otherwise, it's very difficult to make that argument. Now, keep in mind, if you're offering PCS and it's part of your negotiation, part of your contract, it's going to be very hard to make this argument. So making the assertion and reporting under the assumption that PCS is insignificant is not always easy to sustain or defend. Now, what are the conditions under which one could show or effectively defend the accounting method whereby you do not account for the PCS separately? For example, one condition would be that PCS is included in the initial licensing fee, and at the same time that you also have to keep in mind that the PCS term should be 1 be very hard to say that it's insignificant if you're offering services for substantially more than 1 year. Another requirement would be that the cost is insignificant. And then finally, you have to be able to show that the unspecified upgrades and enhancements have both been historically so and are expected to continue to be minimal and infrequent. Now, one of the things that I would recommend being very careful about when you make this assertion is you should take a look at how much of your R&D unit's time and resources, what extent are the resources being spent on what you would normally think of as PCS, which then brings me to the point that with respect to PCS, you really have to start, if you don't have it at the moment, you need to have very good documentation of the different components, how much time you're spending on it. And I would recommend being very, very proactive about this documentation for another reason. See, if you understand, your management understands how much it costs to provide phone support, how much it costs to provide bug fixes, how much time and resources of the research and development unit, the software engineers, is being spent on the upgrades and enhancements, it'll allow you to manage that component much better. And cost containment with respect to that is a very, very critical thing. So from that perspective, I would recommend that whenever you think about PCS, whether you're trying to determine that the proper accounting should be treatment as if the PCS is insignificant, or you should separate it, you still want to make sure you understand how much money is being spent, how much management time is necessary to do this correctly, and to do this such that you retain and then renew your customer subscriptions or purchases. So that brings us to a very important aspect, and that is, how does one develop the evidence for PCS? In other words, the evidence of the fair value. Okay. Now, generally speaking, as always, you remember from our previous webcast, you may also recall from having worked on 97-2, 98-9, and actually just simply applying the software revenue recognition standards to your firm's transactions. I'm sure you recall that VSOE is effectively obtained by recourse to the prices at which you normally sell that item on a standalone basis. In other words, in the case of PCS, how much do you sell PCS for when you sell it separately, which normally means what's the renewal rate, right? So in other words, not the initial PCS, but what you need to emphasize is effectively the renewals. Now, having said that, sometimes what happens is that if you have PCS rates that are lower than the renewal rates, in other words, if the initial term PCS is lower than the renewal rate or what you have as a VSOE, that clearly should tell you that you have a discount in the initial transaction. Of course, if you have a discount, what that means is you're going to have to carve out that fair value from the total arrangement consideration, which means that it effectively changes or lowers, rather I should say, the amount of revenue that you can recognize up front. Because remember, the amount that's allocated to PCS is going to be recognized on a ratable basis. And generally speaking, you're going to have at least a year of PCS, which means that component is now being allocated over and recognized over a 12-month period, whereas very often the amount that relates to the license itself would be recognized upon delivery. And that's why it's important to know as much as you can, to have as much information, and if you don't have it, then develop the VSOE for the PCS. Now, let's take a look at a couple of other aspects of the PCS and how we account for it. So my first example comes from one of the technical practice aids. Now, you'll notice throughout the materials that I have for you that there's a heavy reliance on the technical practice aids, but that's simply because that's our primary form of implementation guidance. So I'm going to point out what the technical practice aids tell us, and then whenever it's necessary or relevant, I will also tell you what else we need to think about with respect to that particular issue or inquiry as it may be. So in this case, we begin by looking at a company that offers a perpetual license for $1 million and post-contract support with that license for $150,000. Now, what does the customer get for $1 million? The right to use an unlimited number of copies of the software for a period of 3 years. Now, during that 3-year period, remember, for the first year, the customer pays $150,000 for the PCS. Now, for years 2 and 3, the customer is permitted effectively to renew at the same $150,000 rate. Now, keep in mind, during that 3-year period, there's an unlimited use right that the customer has. Now, the contract calls for a different renewal rate for the PCS in years 4 and onwards. Now, there's not only is the PCS different. First, let me tell you how it's measured in years 4 and onwards, or thereafter, if you wish. The 4th year PCS and thereafter PCS is based on the number of copies used. Now, notice what's interesting here is that in the first 3 years, the customer had a right to an unlimited number of copies. Now, in years 4, if they add copies to the ones that they had in year 3, they're going to have to pay for the additional copies. In other words, it's possible that the customer has a different number, generally speaking, higher number of copies in use in years 4 and onwards, and therefore the amount paid is also going to change, the amount paid for PCS. The first question here is whether the renewal rates for years 2 and 3, in other words, the $150,000 price that we have in years 2 and 3 for renewal, whether that constitutes VSOE for year 1 PCS. Here's the one drawback I always think about webcasts, because I obviously can't let you can't have you answering this question or trying it, but I would like to. So I'd like you to think about it. You see, the interesting point that we were dealing with at the ACSEC with respect to this question is, what do you do when a company, a seller of software, offers 2 different methods or models of renewal, if you wish? Right? You see what's happening here in this scenario. The first 3 years, you pay $150,000 a year for PCS. But years 4 and onwards, it could be completely different. And it is because there are 2 different models of 2 different pricing mechanisms for PCS that we don't actually have VSOE. So the first point being done, let's ask the next question. So because you don't have PCS, VSOE of PCS, what are you going to do? What the seller has to do here is assume that when the customer pays for year 1, they're going to pay $1,150,000. Now, because there's a right to use an unlimited number of copies in years 2 and 3, the total expected revenue, therefore, is $1.45 million. And because we don't have VSOE of the PCS, we cannot separate it from the license fee. And therefore, we combine the license and the PCS. The total amount expected is $1.45 million, and we recognize 1/3 of that amount each year. Now, let's make the assumption that PCS is not renewed for years 2 and 3. Right? The customer buys it for year 1 because they have to, but years 2 and 3 they decline it. In that case, whatever remains. Now, remember, this time what remains is out of $1.15 million, because the other $300,000, the payment of $150,000 each for years 2 and 3, is not going to happen, because whatever remains, remember I said it was $1.45 million, you'd recognize one-third of it, and then you subtract that from $1.15 million and recognize that when it's known that the customer is not going to buy PCS for years 2 and 3. Now, having said that, we at the ACSEC also decided to see if we could find a set of conditions under which we could define PCS. And what we decided was that if you have evidence to show that the renewal rate in years 4 and thereafter will either be substantially the same, it's sort of close to 150,000, or it'll be less than 150,000 in years 4 and thereafter, in that case, it's substantially the same, and therefore you have VSOE. You see, in that case, you'd be able to separate the 150, and you'd be recognizing the $1 million on the delivery of the license. Now, what type of evidence do you need? First, of course, if you have similar transactions where you could demonstrate what has actually happened and show that the amount paid in years 4 and thereafter is either approximately the same as 150,000 or it's less than that. Of course, you realize that's going to be tricky because you need to have a sufficient number of customers renew the license in years 4 and 5. One other possibility is to be a little bit more careful in this contract, and when you spell things out and you enter into this contract, you ought to state caps or maximum amounts that can be charged for PCS, which would then show that it is your intention, you agree that you've given the customer, already given this customer the amount, the maximum amount that you'll charge, and thereby show that you actually have VSOE. And that would be much better than having to wait for a substantial number of transactions to occur, of course, in years 4 and 5. Now, let's take a look at an example that I've just to show you as a disclosure. Now, here the company tells us that they actually have 2 types of contract terms. And Cognos says that contracts with either a stated renewal rate or a stated rate of first-year PCS that's bundled with the license itself. That's one category. A second category is contracts or transactions that don't have a stated rate. Now, in the first category, where there is a stated renewal rate, that particular stated rate is used to allocate the arrangement consideration. Okay? And then, of course, now that you can allocate, you recognizing revenue ratably is a straightforward argument. And what's their rationale? They tell us that there's a high correlation between the amounts allocated to PCS in the initial licensing arrangement and the renewal rate. So that gives us basically it's telling us that they have the VSOE in that case. Now, with respect to the second category, where, remember, the idea was that you do not have a stated renewal rate. In that case, you allocate a consistent percentage of the license fee. Okay? And historically now they're saying that in this category, there's a high correlation between the mean of the amounts that are allocated to PCS in the initial arrangement and the mean PCS renewal rate. So once again, the basis is the correlation. And they also go on to tell us that customers are then stratified into 3 classes to establish VSOE. And then they give us the criteria that they use to stratify customers. And I recommend that you take a look at this too, because please keep in mind, and we've discussed this in a previous webcast, that in the development of VSOE, stratification makes sense. But you have to be careful in how you do it. So here's just one example of what one company does. You'll see also they go on to tell us that when PCS in individual transactions is below the lower limits of an acceptable range, then the amount allocated to PCS is adjusted upwards to that low end of the range. In other words, you carve out more. And then the adjustment allocates additional revenue from the total license amount. they recognize less up front. On the other hand, if the stated PCS is above the reasonable range, the company tells us they don't make an adjustment. Now, when we do a follow-up, we'll talk about this issue of ranges. There's some discussion in practice of what to do when you have acceptable ranges rather than acceptable, say, point estimates, if you wish, of the PCS renewal rate. But we'll leave that for a subsequent discussion. Then we come to a concept of implied PCS. Basically what that means is that either a group of a particular class of customers or all your customers for a particular software product are receiving phone support, bug fixes, as well as unspecified upgrades or enhancements. In other words, they're getting PCS even though the contract does not really spell out what, that does not actually say that the customer is receiving or buying PCS. So that's what we mean by implied PCS. In other words, one possibility, the condition under which to have implied PCS is sort of what many companies will call a warranty period during which everybody gets a certain amount of those services and the upgrades and enhancements that are developed within that time period. Or either because of practice, which you've effectively initiated, which the vendor has decided upon, or because customers have been asking, you have been providing upgrades and enhancements during a period that precedes the customer's actual purchase of PCS. So those are just two types, or two examples of what I would call implied PCS. So I left a question here for you, and that is, how should we account for implied PCS? Now, implied PCS in substance is the same as PCS, which is what the term means, which means just like PCS, it's a separate element, and therefore, just like other PCS, you need VSOE for that PCS deliverable, and you need to separate it. If you can't separate it, then you're going to have to combine it with the license and recognize the whole thing ratably. Okay, now let's take a look at what happens with respect to PCS in multiple element arrangements. Now, the interesting question here, of course, is what do you have to do with PCS? Generally speaking, as I just pointed out, you must treat it as a separate element, which means you need VSOE, without which you can't allocate any portion of the arrangement. Now, at the same time, there's a caveat. I do want you to pay very careful attention to whether there are either general or specific refund rights. Now, those refund rights may have an impact on your accounting for PCS, so do take a look at that. Now, please keep in mind, I'm not talking here about contingent revenue as that concept is discussed in EITF 0021. But please keep in mind that you need to understand the distinction between general, specific refund rights, and then third, contingent revenue. And that will have an impact on the accounting, which you need to be aware of. Our next issue is that when you do have PCS and multiple element arrangements, how do you separate them? Remember, the fundamental concept of 0021 is the separation and the allocation, total arrangement consideration, or the subsequent allocation of the arrangement consideration to the elements that you've separated. Now, I've given you two examples here. My first example is that you have an arrangement that includes SOP 97-2 software and post-contract support. How would you separate them? In other words, the question is, do you apply the separation guidance of EITF 0021 or that of 97-2? Now, what you have to keep in mind very clearly is that SOPs are higher level literature than EITF consensuses. SOPs are level B gap, EITF consensuses are level C gap. So when you have, I should say, a multiple element arrangement that contains deliverables that are within the scope of higher level literature, notice the first condition, all the deliverables are within the scope of the higher level literature, Now, clearly, SOP 97-2 contains separation and allocation guidelines. In my first example, the arrangement included 97-2 software and post-contract support, which is considered a 97-2 deliverable, which means you're going to use 97-2 guidelines to separate these two, the software license and the post-contract support. My next question was, what if you have 81-1 software deliverables and post-contract support? What's an 81-1 software deliverable? It's actually a software transaction which requires significant modification, customization, training, installation, etc. Now, if those are the case, that's the case, then you may end up using 81-1. But what I'm saying here is you've got 81-1 deliverables as well as post-contract support deliverables. So you see what happens when you have two. One is an 81-1 deliverable, the other is a post-contract support deliverable. In that case, you have a problem because you see 81-1 does not tell you what to do when there are non-81-1 deliverables in the arrangement. There's a December 2003 AICPA National Conference speech given by an SEC staff member wherein the SEC staff clarified that when you have an arrangement that contains both an 81-1 deliverable and a non-81-1 deliverable, you must first use the EITF 0021 separation guidance to separate those two. And then if you have a number of 81-1 deliverables, you apply 81-1 to that. Now, I want you to be careful about this because there is a technical practice aid that gives you a different answer, but there are 2 points I'd like to make. First, the technical practice aid was issued prior to the issuance of the EITF 0021 consensus, which talked about the interaction of higher-level literature and 0021. The second point, in any case, remember, technical practice aids are not higher-level gap. Because remember, SOP EITF consensuses are level C gap, whereas technical practice aid implementation guidance of this type is below level C. Okay? Now, what happens is that in some cases, you may not have the VSOE that you need to separate PCS, and if it's an SOP 81-1 software deliverable, then chances are it's going to be very difficult for you to develop reasonable and reliable estimates of the gross margin and or the progress towards completion. And remember, in order to apply 81-1 and contract accounting, in other words, you need the ability to develop reasonable and reliable estimates of three things: revenues, costs, and progress towards completion. If you're missing one or more of those, generally speaking, you're going to end up in completed contract. So in that case, the point is that when you do have PCS and you have problems with VSOE, chances are that you'll end up with completed contract, which certainly means a significant delay in revenue recognition. So do keep that in mind for multiple element arrangements. Now, we do have a series of other TPAs as well that we will take a look at. Now, actually, let me go back for a second. There's a point I want to make over here with respect to the completed contract and or the percentage of completion. If you do have questions or issues with respect to the VSOE and then subsequently with respect to the ability to develop reasonable and reliable estimates of revenue and or progress towards completion, you may find some people in practice have been recommending a zero gross margin method. Now, you could say that there's some support for that in 81-1. At the same time, I've always thought of it as lukewarm support. So you might want to keep that in mind. Because, in other words, the onus is on you then to make sure that you can defend the choice of using the zero gross margin method. It's not always an easy thing to do. Okay. Now we come to some of the other technical practice aids. And let's do this one, and then we'll stop and give you at least a few moments for questions or Bob, do you have questions that you want me to stop for?
No, just keep going, Tony, until about 5 or 10 of, and then we'll get as many questions as we can get in. There's certainly plenty of them. I'm reading them. I'm spending all my time reading them.
Okay. Well, we have to keep you busy too, Bob. Okay, let's look at this one then on 5149, which talks about the application of contract accounting. Now, keep in mind the first point we make here is that under certain circumstances, particularly where the services meet the definition in 65, you account for them separately. In other words, you have the SOE, etc. Now, paragraph 63, however, very clearly says that paragraph 65 services do not include PCS. And remember, that's what I started with. My first point today was that PCS includes services that are not in paragraph 63 and 65. Okay, or 65 and 66, I'm sorry. Now, the question is where you have an arrangement that's subject to contract accounting and it includes PCS-related services, how should you account for those PCS-related services? The answer, of course, depends on whether you have VSOE. In the event that you have VSOE, great, you can separate the PCS and everything is perfectly fine. In other words, the rest of it then ends up being accounted for under contract accounting. Problem, of course, is when you don't have that. Now, please keep in mind we've already talked about some of these issues, how do you separate and so on. And I just point out the discussion I have in the 2007 Revenue Recognition Guide where I give you the basis for making these adjustments. Okay? Having said that, let's briefly take a look at 5152. And here it's an interesting issue that we looked at, that the ACSEC looked at. And the question here was if you have a perpetual software license wherein there is PCS for a term of 2 years and only 1 year PCS renewals are offered. Okay? Now the question is whether the PCS renewal rates that we have on hand, do they provide VSOE of the fair value of PCS that is bundled in a software arrangement? Okay? And the point here is that it depends on whether the PCS renewal rate and the term are substantive. Right? So now keep in mind, both have to be substantive in order to say that, yes, you have VSOE. In other words, what happens is that you multiply the 1 year renewal rate by 2, and that gives you the VSOE of the 2 year bundled PCS. Now, let's take a look at the next one where we have a multiple element arrangement, which is subject to 97-2, and there is a 1 year software license which bundles 6 months of PCS services. And that's being sold for $100,000. And now, in addition to that, you can buy an additional 6 months of PCS for $5,000. Okay? So now what we're talking about is a time-based license that includes PCS, and the duration of the included PCS is so short that the renewal may not reflect the VSOE. Okay? Now, the point is that it really depends on the fair value measurement that you have. So as I've noted over here, when you have a time-based license with a duration of 1 year or less, it's difficult to come up with a reliable measure of VSOE of fair value for the bundled PCS by reference to the renewal rate. The real problem is that effectively the term of the PCS is so short that any unspecified upgrade that's provided in that time period effectively means that it's hard to determine what the VSOE of the fair value is. Okay? And even though it may not be of significant value, please keep in mind that SOP 97-2 still does not give you an out. That is, it doesn't mean you can ignore the VSOE argument. So the point is that if you don't have VSOE, of course, the total arrangement fee will be treated as if it applies to a single arrangement. Okay? Now, before we go to that, actually, I think, what do you think, Bob? How does this sound for a break period, break point?
Yeah, I think that's good for now. We do have plenty of questions. I won't be able to get to them all. Some of them are very specific, and some of them are broader, so I'll kind of alternate a little bit and see what I could do. Just for a specific question, can you just clarify, because there's confusion, Tony, so if you have an 81-1 contract when VSOE does not exist for the PCS element, is completed contract accounting required?
Well, what I was saying was that generally speaking, it's quite likely you're going to end up in completed contract. It's not that it's required, but you're going to probably end up there simply because of the difficulty of developing reasonable, reliable estimates of those three, the revenues, the costs, as well as the progress towards completion. So although it's not necessary that you always end up there, there's a reasonable chance that you are going to end up there.
Okay. I'll remind people copies of the slides will be forthcoming, and we'll give you that. If you didn't hear that at the front end, we'll give you the instructions on how to get them very soon, because we've had more questions about that. Tony, if a company always sells a PCS with a product, kind of a bundled, can they ever get VSOE for the product? Not PCS, but if they always sell the PCS with the product or a bundle of products, can they ever get VSOE for that product?
Well, the way that question is stated, Bob, it seems very difficult to come up with a situation.
Okay.
But simply because, there's no standalone value, which is the fundamental rationale or basis you need. So you're not selling the product apart from the PCS, which means they're always sold together, and in effect, it's a single element. Even though it's a combined one, but it's a single element.
Okay, well, let's raise it up a little bit, because, again, it's very hard to deal with all scenarios here. What would you say is some implications for VSOE when a firm is selling through channels, distributors and resellers, things like that? Just generally speaking, does this change anything? What else do they need to look like if much of their business is indirect?
It's not necessarily going to change it that much, but it will have an impact because of two reasons that come to mind. The first one is that when you're selling through resellers, the control issue as to how much the reseller charges for that PCS, that may or may not be, and it's unlikely to be as much or as well controlled as if you were doing it yourself, because you really can't tell the reseller salespeople what to do very often or can't really observe them. So that's one problem. And the other issue then is that sometimes when companies do it through resellers, there's some question of who is providing the phone support and things like that. So you want to be very careful about who's responsible for phone support, bug fixes, and so on. And it would be helpful if the customer were clear on that as well, if the end user was clear. The clearer the contracts are, the better you can document what's going on, the fewer problems you're going to have. But it does add an extra dimension of complexity to the process of developing the VSOE.
Okay, Tony, on the Cognos example, you mentioned stratification, and we had a few questions about that. Stratifying customers into different classes. What would be a common way to do that, or different what you've seen or other people doing in terms of what are examples of stratification?
Okay. Distribution channels, wholesale versus retail customers, resellers versus end users. Another category would be volume. If there are customers who buy fewer than X copies, and then those who buy more than X copies. Those are the common ones. Geographic regions, for example. You may decide that North America and Canada, for example, are similar, but the sales in Mexico and elsewhere in South America are different. It's possible that sales in Europe may be segmented into Eastern versus Western Europe, things like that.
Any thoughts on product line? Because that was asked as well.
Yes, you can, and certainly I would consider it along product lines. The normal principle that I recommend to people is that you really need to understand why whoever, whatever section of the business, whatever you want to call the strategy people. So the people who devise the sales strategies, how the company management decides how to sell the product, where to sell the product, those are some of the things that you need to understand very clearly before the financial reporting people can develop the stratification.
Okay. Many companies have to share their product roadmaps with prospects, Tony, about where you're going. I know I'm buying version X, but what does the future bring at a high level? Is that a fine line between specified and unspecified?
It's very difficult, yes. You have to be very careful. See, in these days with the short technological cycles that we have, you really have to share that with customers. You have to tell them where you're going.
Right.
But it's very difficult. You fall into specifics, and there are different places that you have to watch for. Sometimes you say things in response to an RFP. And customers say, okay, we were looking for such and such software. Tell us what it can do. And sometimes the RFPs contain a specific question with respect to the roadmap. You've got to be very, very careful how you answer that. Another place that companies often trip up is that their websites will tell you a lot more about the roadmap than the contract does. But there's no difference. The auditors are going to look at that as well. So yes, it's a very fine line, requires an extraordinary amount of judgment, and this is something that you have, the CFO and the president and CEO of the company must be very, very clear. The general counsel has to be very clear about this too, because this is one of the most critical types of reporting risks that there is in a contract.
Many of our customers, Tony, offer hosted services, and their products are offered on a hosted basis. So we have some questions around that. Is it possible to establish fair value for their managed services, their ASP or hosted services? And can they have a stated renewal rate in the contract? Have you seen much of that?
Yes. And actually the answer basically is yes, you can, and I think you ought to do it. You really should work at developing the fair value. And the reason is that there's another aspect of hosting that's absolutely critical, and that is whether that hosting is a 97-2 element or not. Got to be very careful with that, and that's EITF 003, I should say. And that EITF gives you the criteria that you must meet in order to say that hosting is a component of 97-2. If it fails that, then you've got a multiple element arrangement that has some 97-2 deliverables and then hosting, because it did not fall under 003, which is a non-97-2 deliverable. And you're definitely going to need the fair value. So whenever you provide hosting, managed services, be careful about that. But one other point I'd make is, unfortunately, I'm noticing that more and more companies are not as precise as they should be. So if you're really going to use the term hosting in a contract or in an RFP, a response to an RFP, my recommendation is that both the legal counsel and the financial reporting people and the sales would better be very, very clear about what hosting means in a software environment.
Okay. A brief answer, if possible. What is your opinion on these rules, on where these rules are going in conjunction with the international standards harmonization?
Okay. Well, right now the international accounting standards don't have very much on software revenue recognition. So at this point in time, I don't think that there is much to see in the international standards. Whether they're going to do something depends, I think, because every time you ask them that, they're going to tell you that we're waiting for the revenue recognition project to be resolved. So at this point, there isn't much in there. I'm certainly working on, I'm going to be adding a chapter on international accounting for revenue recognition pretty soon to the guide. But at the moment, I would say it isn't clear what's going to happen. I found lots of foreign companies, European companies, actually applying 97-2, 98-9, and some of the EITFs.
Mm-hmm. thank you, Tony. It was really great to drill down on this topic. The questions were very detailed, and certainly there's more to come on this topic and other similar topics. I'd like to thank our audience for their attendance and their participation, and thank you for the people who submitted many more questions that we could get to. Please continue to look at our websites, www.softtrax.com and revenuerecognition.com, for future events such as these.
Bob, I just wanted to say one thing.
Yes.
The last slide that the participants get has a list of upcoming fall 2007 seminars. So, if you want to answer some of the questions that I asked you during the webcast and have a debate with me, come over to one of those.
As you said, sometimes it's better in person than in webcast. So, but with 1,000 people on the line, we have to have a certain format. So yes, when you do get the slides, and again, the way to get the slides is right about now. You should see a browser an address there to enter into your browser. Please do that. That gives us feedback on today. It gives us the opportunity for you to get copies of the slides and copies of the events that Tony mentioned, and allows 10 people to get the revenue recognition guide. Tony, one of the questions was that if they weren't one of the 10, where do they get the revenue recognition guide? If they're not one of the lucky 10 that we're going to give away to, where do they find this if they want to buy it?
It's published by CCH, so that's the CCH website is one place, and then the second is they can look at my website where I have a link and enough information that'll tell them.
Okay, great. Okay, we're up against the clock, Tony. Thank you very much as always, and thank you to our audience, and we'll be back again soon enough.